Hello and good day. Steve Charlton here, coming to you with another dose of financial wisdom. At Wisdom Financial, it is our mission, our goal, our purpose to provide you with holistic financial planning, uncovering the truths about achieving financial success for your lifetime. So sit back, relax, and let's dive into today's topic to help guide you on your journey to financial freedom. AI, artificial intelligence, is driving all of the market's gains, but that might not necessarily be a bad thing. But it is an uneven rally for sure. Could it, might it, will it have some legs? U.S. stocks are having a decent year this year, and that's mostly thanks to a small number of companies and a huge amount of artificial intelligence hype. And you can see the very nature of the market's two-speed advance by simply comparing the equal-weighted S&P 500 index compared to the market cap-weighted S&P 500 index. And put simply, it shows that this index tech-heavy giants are driving its overall gains, with the equal-weighted index trailing its cap-weighted cousin by the widest margin ever in history. This, according to Bloomberg. The narrow breath may be striking, but it doesn't necessarily mean that investors should run for the exits on all of their assets. You see, there have been a total of 15 years over the past 3 decades when the equal-weighted S&P 500 trailed the cap-weighted version. In other words, it happens roughly half the time. And of those 15 instances, 3 ended in losses 12 months later. But the narrow breath is exasperating concerns among investors right now. After all, the AI craze is the only thing propping up the market. Then what happens when the hype dies down? You needn't look too far back in history to remember that the tech sector's extreme dominance set the stage for the dot-com crash in 2001. Of course, some will argue that things are different this time because the handful of tech stocks pushing the market higher today all belong to good companies with what they call assured growth. If the market's leaders consisted solely of low-quality companies, similar to what we witnessed in the late 1990s, then matters would be really, really terrifying. To put that assured growth argument into perspective, consider a recent report by Bloomberg Intelligence. It estimates that generative AI market will expand to a compound annual growth rate of 42%, reaching $1.3 trillion by 2032, up from $40 billion just last year. And that predicts that Meta, Nvidia, Microsoft, Alphabet, and Amazon will be among the biggest winners of the AI boom. With such impressive growth ahead, don't expect the AI hype to die down anytime soon. As always, we hope that this information was useful as we work to help you be informed in advance so that you are prepared properly and do not allow disintermediation to negatively impact your portfolio, especially if you are in or nearing retirement phase and you have a percentage of your assets that you simply cannot lose. If you have any questions or need guidance on maintaining financial stability regardless of the economic climate, please feel free to schedule a 15-minute call with us below. Just click the calendar link and let's help you get on the right path. As always, like and subscribe so we can continue to serve and offer a voice of truth and logic in very volatile times. Thanks for tuning in, folks. Have an incredible rest of your day. God bless.